Studios, the Ausbiz COB is the key stuff you need to know about the day in business and finance.
Welcome to the COB. I'm Danny Akuye.
And I'm Juliet Sarli. We made it to the finish line, the last final day of trade before the Christmas break. And it's really been kind of like a whimper, as you put it, limping to the finish line here.
It does look like we are limping towards the end of the day. But let's just have a quick check on the market, because we've got half an hour to go before the market closes. But we thought we'd just do something a little different on this last day. So hopefully we will get the SIBO up. If not, the ASX...
There's a little gremlin happening. There we go.
There we go. Look, it's pretty flat, Jules. We can't even manage a 1 point rise at the moment on the SIBO 200. Pretty much 4 points for the ASX 200. But we do have almost another 28 plus minutes to go, so we might see some, some window dressing, shall we say?
For rallying into the close.
For those punters that are still around on this beautiful sunny Friday afternoon in Sydney. But let's get on to the three themes, Jules.
Yeah, so slipping into 2024, or I guess moving in with the whimper, of course the market will be open Wednesday, Thursday, Friday, I think a half day next week. But it is the fact that we are going to be closed. We're not coming back till the new year like so many. And I think when you just, I got my coffee straight away today. They were calling my name before I'd even sort of walked in the building. I heard Juliet. So it just shows you there's very few people around. We've been talking about volumes.
It's very quiet.
It's very quiet.
Absolutely. And it has also been very quiet in the US, but I don't think quite as quiet as it is here. But we do have this US PCE reading for the month of November, which actually is a really important point. I just thought I'd highlight Nick Timiraos, who is known as the Fed Whisperer from the Wall Street Journal. Okay, so we have consensus at 0.2%, although he's saying it might come in at 0 or 0.1%. And this would lower 12-month core PCE inflation to 3.1% in the US and 6-month annualized to 1.9%. So really important, the market looking towards it. We've had a massive rally in US Treasuries off the back of that dovish Powell that we saw last week. Anything higher could cause the bond market to start to sell off. So a few hours to go now before that.
Indeed, and of course a very key metric watched by the Fed. Also talking about lithium blues. Now this is so interesting, this market. It's in such a glut. People saying that it may not even get into a deficit until late 2025, really hurting a lot of the lithium players, and Core Lithium was among those falling today, saying it's reviewing its strategy amid these falling prices.
Absolutely. A market that really is oversupplied at the moment, and you are seeing weakness going on in terms of EV sales globally as well. So like a lot of these commodity markets, you have to see them restructure, which is basically what Core Lithium said. So let's have a quick check at some of those lithium stocks, because I think some of them are, Core Lithium, as we can see, off 21%, but Pilbara actually finding some love today, up by 2.5%. And of course, the other story, Jules, are those iron ore futures that have been off to the races. So let's have a look at some of those major material stocks. You own Fortescue, don't you?
I do. Yes, I do. Ouch. I did sell some when there was a huge call, and it's continued to rally to records. But anyway, you can't be greedy, as Andrew Gagan told me. $28.37. Did touch an even higher move than that in the afternoon session. Rio was also trading around 135, I think, and BHP there just slightly higher, continuing to see. And I think one of the stories of the year that so many in the market got wrong, that continued rally into iron ore futures. Let's have a look at the banks. ANZ traded ex-div today, pretty flat on the close, held its AGM yesterday. CBA, a lot of people saying, look, quite frothy, above 110, but still holding on there. And the other banks, I guess, a little mixed today.
Absolutely. And utilities, let's see if anything's happening in that space. Contact Energy and Infratil are both positive, but APA, Mercury and AGL undergoing some profit taking. So let's check in with some of the top corporate news. Now, Jules, I think you know about this company that's made a bid for A2B.
Yeah, so I lived in Singapore, as you may or may not know. I think I've spoken about it once or 5,000 times. But ComfortDelGro is the key taxi company there, and it's lobbed a bit at A2B, which has seen A2B shares rise by some 18% today. This $182 million buyout offer. What's really interesting, I find, in Singapore is that Grab, which, you know, they don't have Uber, they have Grab, which is a mega app. It kind of outplays, but a lot of people, similar to what you see with the taxi industry here, that just prefer that old, you know, calling a taxi, not using an app. It still is very, very profitable. So that will be really interesting if there's a tie-up in that space. Absolutely.
And Probiotec, it is up by almost 15% as Indonesian pharmaceutical manufacturer PT Pyridam Pharma has done a buyout offer on that stock.
Yep, so just talking about the whole M&A theme, and Core Lithium we touched on, announcing it's reviewing its business strategy and falling about 21% amid these tumbling lithium prices as well.
And A2 Milk just a tiny bit firmer today, up just over 0.1%, and that's after affirming fiscal 2024 guidance, starting off a commercial disagreement with Synlait.
Okay, let's look at Lynas as well. Had a good day. Leapt despite China's export ban on some rare earth processing technology, up 4.2% in the last little while of trade.
And the stock of the day on the call was Waypoint REIT, and we had Mark Gardner of MPC Markets and Claude Walker from A Rich Life. They gave us a buy, hold or sell verdict.
Bless you, Hien.
We've rolled this around probably 2 or 3 times in the last 2 or 3 years,
right?
I'd
Okay.
Say, we never really have. The risk is buying it too early, basically. So it can get quite thin and nasty. But if you sort of pick your levels and know where you want a bit of yield, it's pretty good.
I think for me personally, it would be enough to just take on any kind of risk really for such a slim upside in terms of the yield. So if I am occasionally can be seduced by a dividend stock. Right now, these days, I'm not that easily seduced by a dividend stock that 6.4% no franking would do it for me. So just for that reason, I call it a hold, and it's not one I'd be buying.
All right, let's welcome to the COB Mathan Somasundram from Deep Data Analytics. Mathan, good to see you. I mean, we are limping here to the finish line as it is ahead of Christmas. What's been your take of, I guess, what we've seen post the Fed pivot party?
Yeah, it's amazing how quickly things change. 12 days before that, they weren't even looking at rate cuts. And 12 days later, the rate cuts is all the rage. But look, the market is running into flow upside. So we had the Chinese outflow that went into developed markets. And then you had the fund managers defending themselves for the December hike. I mean, you have to remember the biggest market is US, and US fund managers, they have a December year end. So they're trying to defend the market as long as they can. So that's holding up the market. So we've had a pretty good run there. And so the market tried to use the rate cuts as the explanation for the reason the market ran up. So we've got about double the dot plots in rate cuts expected, up to 6 to 7 cuts. And then the market kept on running up, so they had to bring it forward. So now we're expecting the first cut as soon as March, which I think is delusional, but it is what it is. When the market runs up, we all have in the market have to come up with a reason why it ran up, and that's the best we've got. So the Fed has become the proxy for rate cuts and potential market movement.
Absolutely, Mathan. It's all about narratives at the end of the day. So speaking of narratives, we've had FedEx results, which certainly the outlook and the results weren't great. Nike also bursting a bit of a consumer bubble there. So whilst the GDP numbers, etc., that have come out, there's been some really strong stats. You're also getting this other company corporate evidence of a slowdown. So are you sitting, dare I say, in that hard landing rather than soft landing camp?
Yeah, every hard landing starts with the narrative that it's a soft landing. And in the last 20 years, the Fed has almost zero track record without stimulus pumping into the economy. So it's a tough one. I think the economy if you look at it overall, it's inequality plays a big part. So parts of the economy are inevitably going to have a hard landing. Will overall have a hard landing? That's going to be, the thing to see. I suspect we will. We always plan for soft landing, and the market is always optimistic till it's not. So the consumers are the ones that have held up better than most people expected. There was a fair amount of stimulus that went through post-COVID, and that's held consumers for a lot longer. And then the consumers turned around and kept on borrowing. And the hope of rate cuts actually has worked against the Fed, and people have just kept on borrowing even more and more. So it's happening in Australia as well. So in that context, I think the consumers have been borrowing, but I think they're reaching that limit. The savings ratios have started to fall off. So I suspect we're going into 2024, consumers are not going to be there to hold it up. Despite their strength, despite the strength even in the employment market, I think consumers will start to fade. And that's what we're seeing with FedEx. That's what we're seeing with Nike. And I think that will be a global trend. I think everywhere, everyone's added a lot of debt. And interest rates, we have to remember, have gone to 5%. Even the most optimistic view is that the Fed rates come back to what, 3.5%, which means mortgage rates are still going to be 5-6%. Compare that to where we were when it was nothing. It's still quite high. So I don't see consumers holding up well into 2024. So the cracks are going to appear. I think the FedEx and Nike are the early canaries in the coal mine.
All right, so that sort of leads into my question I was going to ask you. If you look back on 2023, I'm going to give you a few scenarios. There was potentially peak rates, obviously inflation, some disinflation, the adoption and acceleration of AI. How would you describe 2023? I've had people say today resilience, potentially, patience for investors. And what do you think is going to be the key driver for 2024 if you do think some cracks might appear?
Yeah, I think 2023 is the year of stories. There's been every story you can think of. AI, I love the fact that a lot of people who actually don't understand what AI stands for are telling other people why AI is a growth story. AI has been around for decades. People have been working on it for decades. You don't come up with AI overnight. So again, that's hilarious. The NVIDIA story, it's another great story. I mean, it was I think, gaming chip, and then it was a crypto chip, and then it's a AI chip. You name it, NVIDIA will do it for you. So it's the year of stories. You've had, I think there's been a story about China stimulus once a week, almost, and none of them in 2023 has played out. So it is the year of stories. And I think going into 2024, I think it's going to be interesting to see. I think macro will be dominant in 2024. I mean, we are on the verge of a big cycle out of Japan, where Japan might actually exit negative rates, 30, 40 years. And there is a very high risk, the way things are going in the US with the election coming. I think you will get potential of 70s style secondary inflation cycle. So there is real macro risk going into next year. There's going to be a lot of elections. There's going to be a lot of politics. And I think geopolitics is going to be massive. So the macro is not going to go away. I think macro is going to be a big story next year. Central banks had the interest rate weapon to use. I think they're mostly done. The best they've got is probably one hike, and then they are stuck basically watching things happen. So in that context, I think central banks don't have much weaponry. So it's going to be macro. And I think you would need to have, I guess, you need to have a very diversified defensive play in your arsenal to play against it. So hedge yourself. It's going to get bumpy. Valuations are expensive. Markets are expecting a lot of rate cuts, which I don't think is possible. Because if they do happen, then inflation is going to really take off. So
right.
You kind of have to balance it out.
So Mathan, you're basically, because I follow you on Twitter, as you know, you're still a bit grizzly. You've been a bit grizzly this year. You're still a bit grizzly going into next year. I've had a couple of guests citing their concerns over private credit markets. Is that potentially giving some nasties to come out if it's not necessarily the credit cycle turning, but then it could be the structures that they sit in. It's that classic case of everybody got into that, everybody's made a lot of money, which means everybody is now a credit specialist, and it's dragged in all the retail punters. If we were to just stand back and look for the unpredictable, what would be your one or two unpredictable things next year?
Yeah, I think the great line from the movie Margin Call, when Jeremy Iron actually says, it's not about when you get in, it's about when you get out. So it's going to be tricky for markets and investors going into next year. I think the thing that you have to look at is what the market not pricing in at all. So, for example, everyone's pricing in that energy prices are looking at recession, while the overall market is pricing in a soft landing. So, these kind of overly optimistic or overly pessimistic bets on one side or the other side, that's where the risk is. So, I think the one that could shock the market is if oil prices actually take off from here. What could shock the market is if the Fed actually cuts as much as everyone expects, because everyone expecting a lot of cuts, but in reality, they know that that's potentially not going to happen. But if the Feds are going to cut at the rate that they're doing, what they're expecting, in reality, if you look at historical data, that means there's a recession coming very quickly. So the things that people are not expecting are a hard landing, a rise in oil price, another inflation cycle, a much lower US dollar. And all of these things are linked to, for me, the shock factor that could happen is a sovereign debt risk. So I don't think it's private debt that I'm worried about. I'm more worried about sovereign debt, because everyone has made a lot of money because every government out there has basically expanded their debt. So everyone's on historical high debt to GDP. So can they keep that going? Well, that means there's going to be a lot more bond issuance, which is going to put pressure. So at some point, that's going to hit a limit, and then the weakest ones fall first. So I think the sovereign risk for me is the biggest risk, but look for the areas where people are not expecting it to happen, like oil price going higher or US dollar coming off too much or a US recession, which is all of these things are not being priced. That's what the risk is.
All right, well, on that note, we'll try and look at some optimism. But Mathan, have a great holiday season. We thank you so much for all your contributions to AusBiz throughout 2023 as well.
Absolutely, Mathan. Thank you so much. And wishing you a Merry Christmas and a Happy Holidays.
All right, Mathan.
You too, guys.
Somasundaram from Deep Data Analytics.
Yeah, so now to welcome our next guest on the COB, because we have such a special program, we have Shane Oliver from AMP. Shane, thank you so much on this Friday afternoon for joining us. Now, we've just been listening to Mathan Somasundaram, who he's usually a little bit of a bear, but he's feeling really grisly about 2024. Cheer us up. What's your outlook?
Well, the bears get more grisly whenever markets go up. That makes them even more annoyed. They're mostly happy when markets are going down. And right now, markets have been going up. So you can understand why the bears are getting grisly. But there are things to be optimistic about. Inflation has come down. Go back a year ago, a lot of scepticism about that. Secondly, flowing from that, central banks have reached the top, most likely in Australia as well, but certainly elsewhere. And that will mean lower interest rates. And don't forget, all that rough patch we had in 2022 was because central banks raised rates. As they come down next year, ultimately it should be a positive, even though there's you're going to get a rough ride along the way. So it's not going to go up in a straight line. Thirdly, I think if we do go into recession, and that risk is there, I'd have to concede the bears on that point. We could have a recession. I think there's good reason to expect that it will be relatively mild, because we don't have the spending excesses that you normally have that have to be unwound in recessions. And finally, you could just make the point that so far we've had this almost immaculate decline in inflation. Inflation has come down without driving recession, or at least severe recession. And you'd have to say that's a good thing, and that could quite possibly continue. So overall, I'm pretty optimistic we'll see further gains next year, but I do concede somewhere along the way we're probably going to have at least a 10% correction. And it is just worth bearing in mind that we did in 2023 as well. We had that fall from the July highs to the October lows in global shares, which was about 10%, I think a little bit less than that in Australia. So you'd have to assume that at some point you get something like that. And I suspect it's around recession risks. But overall, I think with inflation coming down, central banks moving towards rate cuts, that has to be seen as a pretty good thing.
So that's your reasons for optimism. We've just been looking at your key themes for 2023 as well. Quite a few there. And I mean, we were talking to Mathan about that as well, and he said AI has been around for ages, but I think your point was the adoption and acceleration of AI. How would you kind of sum up 2023 if you had to in a few words or less?
Well, I'd sum it up as Goldilocks. The fear at the start of the year was certainly not Goldilocks, it was stagflation. We ended up with Goldilocks, reasonable growth generally on a global average basis, not perfect. You could argue that Europe might be in a very mild recession, and Australia certainly slowed down, but growth overall has been okay. We've still got very low unemployment, even though some of the heat's come out of there, and we've seen falling inflation. If you look at the US inflation numbers for the September quarter that came out overnight, they're annualising 2%, which is bang on target. So the best word to sum it up would be Goldilocks. And on geopolitics, which I missed out there in terms of themes, that turned out to be pretty benign through the last year. I mean, mind you, we've got another week to go, so anything could still happen. But the geopolitical threat wasn't anywhere near as severe. There was a lack of elections in 2023. The China-US tension soared a little bit, which was good news. The Israeli crisis hasn't yet, at least, turned into a major conflagration that threatens oil supplies globally in a big way. And, of course, the conflict in Ukraine continues, but it hasn't spilled over. So that's been a major positive theme, I guess. But on terms of AI, I think that sort of provided that bit of optimism and euphoria in some parts of the market. And yes, it's certainly been around for a long time. I remember first looking at things around artificial intelligence back in the 1990s, but it now has hit the big time. It's gone mainstream, and that does offer hope that ultimately it could turn around the poor productivity performance we see in services sectors. So that's obviously caused a lot of excitement, and you'd have to say that supercharged share markets other than our own. It certainly supercharged the US share market, particularly the tech stocks there.
Shane, if we actually get interest rates coming down, do you think that's going to provide the tailwinds for cyclical markets like Australia to perform? And it's quite interesting that iron ore futures continue to march steadily higher. I believe they're $140 a tonne today, but which has surprised a lot of people. But will 2024 be the year for the Australian share market to, breach those previous highs?
Well, I certainly hope so, and we have got closer. When I first put my Outlook note together a week or so ago, I thought, well, we'll make it up to 7,500, but we're already there on the index. The high was, I think 76.30 or 76.28 back in August of 2021 from memory. We're not that far away from it. I think about 1.5% or so away. So I think we will get through those highs and probably end the year up at around 7,800. So I think we will finally get through those highs. Last year, the Aussie share market, believe it or not, we had a rough year, but we outperformed global markets. This year, 2023, we've underperformed. Looks like we're going to have a pretty good year once the market like today up 6.7%, adding the dividends, adding the franking credits, they're up around 11.5%, which is a pretty good outcome. It's just that global markets have done 20% plus. So next year, I wouldn't be at all surprised if we become a relative outperformer again. But I have to say there is risk around that. So I don't think it's a strong view that I would hold, but I am reasonably optimistic for the local market. And several things I think will help. I think the Chinese economy will keep motoring along. Lots of the lustre has been taken off their growth story, but it probably keeps going with bouts of stimulus helping. And in Australia, we probably will go through the worst of the threat to the household sector with the mortgage threat. And as the year proceeds, interest rates come down, then that threat will start to recede to some degree. So I am optimistic that, we'll at least hold our own versus global markets in the year ahead, possibly outperform a bit.
Well, that is good. We love a bit of optimism. Shane, I'm going to go first because I've had a lot of time this year. I did an 8-month sabbatical to read, to watch things. My favourite book that I read was Prima Facie, which is a one-woman play, but it's an excellent book. And my favourite TV show was Jury Duty, which if anybody hasn't watched it, has to watch it. It is incredible. You go, because I know you've got a really busy job. How do you kind of unwind? What was the best thing that you read or watched? Or was it in fact the Beatles concert?
Well, actually, you've probably hit the nail on the head there. It probably was the Paul McCartney concert. I thought that was a fantastic event. It was something I didn't think would happen again. I saw him in 2017, so that was amazing to see him live in concert for 3 hours, which is similar to what Taylor Swift does. So doing fantastically well. So that was certainly a highlight. I also had a holiday to Germany, which was a bit of a highlight. And after that, I read the book that I might have referred to on this called Stasi-Land. I think if you're worried about government intervention in the economy going too far, then Stasi-Land reminds you that you certainly don't want to go too far. You don't want to go down the approach where we've got a command economy and a police state like those countries used to have. That's a dead end. To me, it's been a good year. I can't say things stick out. If I go back to the previous 2 years, Bridgerton would have ranked as my favourite TV shows. This year we had, was it Queen Charlotte? I think.
Yes.
Which was good, but if I got that right, it wasn't quite as good. Yeah. It wasn't quite as good as Bridgerton was in the last couple of years. But nevertheless, I've had lots of fun this year. It's been a nice one. And it's also been nice to be free to a greater degree of COVID than we were in the previous years.
Indeed.
Absolutely. I can only offer up that I picked 2 of the worst films I've ever seen this year. We decided to go to the Scandinavian Film Festival, and I picked apparently what was a Finnish quote unquote comedy. Nobody told me the Finns actually don't do comedy.
Oh dear.
So we had to walk out of that one, and then there was some arty-farty film with all the best actors in Hollywood going to anyway, forget about it. So that's my claim to fame. I read Morgan Hassel's The Psychology of Money on the Plane to Vanuatu, and I recommend that to everybody. I thought that was a really good read, and particularly, I don't know if you've read it, Shane, but the last part.
I haven't.
It's great, and particularly the last part, because he talks about what happened to the US economy post-World War II when they dropped interest rates to zero and basically gave money away to all these homecoming servicemen who were young, unemployed, had no assets. And that's what kick-started the economy. And it's interesting because some people are comparing the pandemic disruption to what happened post-World War II. So I'll leave it there.
But before we do leave it, we want to thank Dr. Shane Oliver, AMP Chief Economist, for all his contributions over 2023. You've been a bright spot in sometimes when it's a bit gloomy, I guess, on the market.
Absolutely.
It's been my pleasure.
Half glass full rather than half empty.
Indeed.
And out of interest, we'll have to do a chat on this one.
Wait, a wide shot.
On the, happily it's showing up there.
Yes, it is. Oh, that's what you're reading now.
Down the bottom there. Guess
Danny's book. Great one. Merry Christmas, Shane.
Thank you, Shane. Yeah. That's very kind.
I'll be going through that over the next couple of weeks.
The other
one, Shamplicity too.
Yeah, that's a bit more in depth. I think you'll probably breeze through the first one. The second one might be a little bit more intellectually challenging, but hey, I'm no Morgan Hassel. But thank you, Shane, so much for all your contributions here to Ausbiz.
My pleasure, thank you.
And Merry Christmas.
Merry Christmas. Let's do the leaders and laggards. We forgot to put our little flowers on our head too.
Yes,
as we
absolutely.
Round out,
we couldn't find any elves hats or anything like that. So hold on, let me just get that one right.
Sorry for those that are listening on the podcast, but we look beautiful. Boss Energy up 7%, Neuron Pharmaceuticals up 6%, Emerald Resources a wee bit nano, Linus, as we mentioned, a front runner today.
Absolutely, and there was an upgrade yesterday on Boss Energy in terms of the broker upgrades. Let's have a look at some of the laggards, and probably no surprises. Core Lithium lithium, although we're still just waiting for closing. Actually, closing prices are just coming through, off by almost 20%. Sayona Mining off by almost 8%. Telix 3%. Chalice another 3%, and Altium off by 1.5%.
All right, let's have a look at the smaller end of town as well. We talked about A2B, this aggressive bid from ComfortDelGro in Singapore, worth more than $180 million. Probiotic also getting a takeover bid from an Indonesian company, Retail Food and CoSolar, which was one of Peter Koppetz's picks on the trade today, up by 11%.
Okay, and the small cap laggards, what have we got there? IODM off by almost 11%. Another Arizona Lithium also off by about 10. 4D Memory under pressure off by about 9, and CT1 Logistics off almost by 8%.
All right, looking ahead, and it's really just looking ahead to tonight, US consumer confidence. Of course, we talked about the PCE, their preferred inflation gauge, personal income and spending data among things coming out.
Yeah, absolutely. There is a plethora though, isn't it, in terms of durable goods orders, new home sales, a lot of potential market moving data coming out of the US. And of course, we're not going to focus on what's happening tomorrow because we're not going to be here on Monday. It's going to be Christmas Day.
Yeah, you know what I'm doing? I'm driving to Canberra, so that's what's happening tomorrow. And you're going Christmas shopping in Bondi Jungle.
No, we're actually going to have a rare treat of a Saturday lunch, which we never, ever, ever do. But friends of ours love to have lunch, so we've booked a Saturday lunch. So let's get a final check on the markets. There we go. A little bit of red. As I said, we are slip sliding away into the end of the year, but there's still a couple more trading days. We won't be here next week, but this rally may not be over. I think basically a lot of the traders taking any risk off running into those key data points like the PCE, and I've got the ASX 200 up by 4 points.
But you know what's worth noting is that, because I read Shane's report last week when he came out, and his call, as he said, was 7,500 by the end of 2024. We're there already. So, you know,
can't complain.
No.
Exactly. Well, Jules,
Merry Christmas.
Cheers.
It's been great working with you.
Absolutely.
And
Merry
the whole
Christmas.
team, Hannah, Purva, everyone else out there.
Exactly. To everyone, if there is anyone out there, but hopefully there's a couple. Merry Christmas, everyone.
Merry Christmas.
Have a happy holiday, and we look forward to catching you in 2024.